Okay, welcome to this lecture on Commodity Channel Index, in short CCI. So a little bit of disclaimer before we move on. Now basically, what is CCI? And this is a creation of Donald R. Lambert back in the 80s. It's a form of oscillator and a leading math-based indicator. So some people will regard this indicator as a leading indicator because a lot of people have this principle that momentum would lead the price. So yes, once in a while you see that CCI will give you the signal first before the price moves, but once in a while again you see it changing into a lagging indicator where the price moves first, then followed by CCI. So there's no hard and fast rule as to whether this is a leading indicator or a lagging indicator. Now this initially developed to track the commodity markets, but nowadays you can use this in stock index, you can use it for options, and at the same time you can also use it for forex markets. Now CCI can help you identify potential market reversal points, and basically this is the indicator that we are talking about. Now the usual levels that people look at is 100. Okay, level 100. When you use level 100, you realize that it will tend to give you a lot of signals. Okay, a lot of signals. So if you are more conservative, what you can do is that you can add more levels. For example, 200. So when the CCI goes above 200, it is highly overbought. But when it goes above 100, then it is just overbought. And at the same time, when it goes below negative 100, it is oversold. But when it goes below 200, it is highly oversold. And when it goes below 300, it is extremely oversold. When it goes above 300, it is extremely overbought. Now you already know that if you're a conservative trader, you would need so-called a lot more filters. So if you're super conservative and you set a level 300 for you to use this as a confirmation, you will get less signals. You realize that, okay? As you add more levels, you get less signals. You see, 1, 2, 3, 4, only 4 overbought signals. Whereas if you use 200, you have 1, 2, 3, 4, 5, 6, 7, and maybe 8 here. So the more levels you add to it, the less signals you'll get. But with that said, the less false signals you get. Now the thing is, how CCI works is almost similar to other indicators. There's a neutral level over here, okay, in the middle, from 100 to negative 100. This is the neutral level, which you don't really want to pay attention to. What you want to take note of is when CCI goes above the extreme levels. If you set it at 100, then when it goes above 100, okay, then it is overbought. Then you want to look for a sell. When it goes below negative 100, then it is oversold. Then you want to look for a buy. This is the main principle. Just understand this first. And also CCI, when you're trading in an uptrend, it will tend to congregate a little bit above. Okay, it will shift slightly above. It will hover between the center level with overbought levels. Okay, when you're trading in a downtrend market, it will hover somewhere a little bit lower, okay, at the oversold level and also at the center level. So the thing is, you see an uptrend over here, and in an uptrend, you see very often times there will be overbought signals. Now you don't want to sell when you see an overbought signal in an uptrend, because when you're selling in an uptrend, you're trading against the trend. Okay, so when you're trading in an uptrend, you just want to look for oversold signals to buy. Alright, so for example, when price comes down and tests this 3 moving averages, there's a confluence here. At the same time, there's an oversold signal. Then you can look for a buy trade. Okay, again, price comes down here, retrace, oversold, it tested 100, pierced through a little bit, and then it bounced up. So you want to get in based on retracement. When the price retraces like this in an uptrend, this means that when a CCI goes to overbought in an uptrend, it just tells you that the uptrend is strong. At the same time, when you see a downtrend, you will see a lot more oversold signals. Okay, and you see that CCI tend to shift a little bit downwards. Do you see that? Initially uptrend, it tends to hover around here, and in a downtrend, it tends to hover around here. When you see oversold signals in a downtrend, you don't want to buy, because oversold signals in a downtrend just tell you that the downtrend is strong. Okay? In a downtrend, you want to look for overbought signals for you to enter. Okay? But not just any overbought signals. The signals has to be the right context. Okay? For example, this is a good one like I showed you just now. It has to come down and test a support level or a critical level. Understand what I'm saying? You cannot just, because uptrend, I saw an oversold signal, then I just buy straight away without looking at the price chart. So the context is very important, okay? Now the thing is, some people use CCI in a different way. They use a center line over here, alright, right in the middle over here, and when the price crosses the center line, then they'll use that as a signal. But I personally don't use it that way. I prefer to look at the oversold, overbought signals, okay? And when it comes to the end of a bullish trend, okay, you will also see overbought signals. When it comes to the end of a downtrend, sometimes you also see an oversold signal, which is a signal for you to start to take profit, to prepare to get out. Now there are 3 ways that you can use CCI. Like I showed you, you can use it to look for overbought and oversold signals. Secondly, you can use it to spot bullish and bearish divergence. More on this later on. And number 3, you can use it to trade a trend line breakout. Okay, again, more on this later. Right, so let's look at the first strategy. So you can see that we have the moving averages, all telling us that it is good for a sell market, it is going on a downtrend. So next you want to find the confluence, or where the price comes up and tests a critical level. Okay, so when it comes to trend line, you want to enter on a third touch. Okay, so this is the first, second, and third. So what you can do is that you can enter here. So you can see that the price came up, tests the trend line, but also at the same time it tests your 100 moving average. Okay, and if you look at the candlestick signal closely, it is an evening star pattern. Alright, so you can see price come out here and test this confluence of the moving average and the trend line, and at the same time you also see that CCI went to overbought. Alright, so this is a high probability trade for you to get into. So what you can do is that you can sell when the evening star is completed over here. Put your stop slightly above 100 SMA. Alright, and then put your TP at the recent swing high over here. Alright, so this will give you a good risk to reward ratio to get into. Okay, another example for you. So this is a bullish trend. So you can see our moving averages. The criteria for an uptrend is fulfilled. Again, we have this trend line over here. Alright, and price came up and touched here the third time. And also price came down here and tested your 100 SMA. And when it tested the 100 SMA and the trend line, there's a confluence, and at the same time CCI gave us a signal where it is oversold. And if you zoom in a little bit, you see a bullish candlestick signal, which is a bullish army. Okay, so what you can do is, again, once this bullish army is completed, make a buy order here. You can put your stop somewhere below the trend line. Okay, and you can put your TP target at the recent swing high or the recent resistance, which is somewhere over here. Okay, but you know what, you can also enter at an earlier point over here. Okay, because at this point in time CCI also gave you oversold signal, and also at the same time it gave you a bullish candlestick signal. Can you see that? There's a long lower wick over here. At the same time you see a long lower wick for this candle over here. So this is if you are a day trader or swing trader, you can hold until the recent swing high. But if you are a trend follower, what you can do is that you can enter at the same points, alright, and you can ride the whole entire trend. And that is for another lesson, or for the future courses that I launch. Okay, give you another example. So this strategy is a bearish divergence strategy. So bearish divergence is when price is making higher lows and making higher highs. Okay, and at the same time CCI is making lower highs, and also lower lows. So what does this tell you? When you see a bearish divergence, it tells you that the trend, the bullish trend in this case, is going to end soon. It's not going to end immediately, but it's going to end soon. So you gotta prepare for it. So the confirmation that the trend has ended is when price broke a long-term trend line. Okay, when it broke long-term trend line, and when your 50 crossed below 100, and at the same time your 200 started to slope down. And of course, when price start to go below, okay, below your moving averages. And also, if you read chart patterns, when price makes two double tops, it doesn't have to be the same height. Okay, chart patterns, I wouldn't cover it in detail. For this course, I'll cover it in another course. So just now was bearish divergence, now is bullish divergence. So bullish divergence is when prices are making lower highs, basically a downtrend, and prices are making lower lows, like that. Okay, prices are going on a downtrend, but you see CCI making higher lows like that. Okay, so when you see a bullish divergence, it tells you that potentially the bearish trend is going to end. So be prepared to get out. So again, confirmation that the trend has ended when price broke a long-term trend line, a significant trend line, and at the same time when your 50 SMA and 100 SMA start to slope up and 50 cross above 100, this is the sign that the trend will end. So basically, use divergence to help you take profits. If you're a beginner, I wouldn't recommend you using this to pick tops and bottoms. You only pick tops and bottoms once you become more experienced. Now, if you compare CCI with stochastics, you realize that both of them tend to give you the signal almost at the same time. Okay, so that's why I don't recommend people to clutter the chart with all the momentum indicators, because most of the time it's just going to give you the same signal. You see CCI goes to oversold, stochastics go to oversold. CCI oversold, oversold, overbought, 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 overbought. Of course, sometimes CCI give you the signal, but stochastics doesn't give you the overbought signal. And over here, overbought, 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 overbought. Now, if you are super conservative, what you can do is that you can add at most two indicators, CCI and stochastics together. You want to enter only when both CCI and stochastics give you the signal to enter. For example, you can see price came out here and test 100 SMA, and at the same time CCI gave you an overbought signal, stochastics gave you overbought signal. So this will give you more confidence for you to get in. But personally, I feel that using one is enough. Just use one that fits your own trading style and personality. More on these comparisons in the next few lessons, so don't worry about that. So the third strategy is trend line breakout. Okay, now a lot of people, they use trend line for their charts, okay, for the price action, but you can also use trend lines for your momentum indicators. So you can see that I drew a trend line for CCI over here. Okay, and when CCI broke this trend line, you can see price shot all the way up. Okay, and at the same time, you can see that CCI, it came down here and tested this trend line again. Okay, so there are some traders who really like using this strategy, but personally, I like to keep it simple because trend line is more subjective. It takes a lot more training to learn how to draw proper trend lines. I prefer to use overbought, oversold signals and also divergence, because it is more straightforward, it is more clear-cut. But with that said, if this strategy works for you, then you can consider it, especially if you are really good at drawing trend lines. So this is for a bullish trend, whereas for a bearish trend, it's the same thing. You draw a trend line, okay? Just like how you draw trend lines for your price action. Test 3 times. When the CCI broke this trend line, you can see that price went downwards a little bit. Again, when it comes back up, comes back down, broke the trend line downwards again, you you can see price continue to go down. Okay, so basically in a bearish trend like this, you want to wait for trading signals when the trend line breaks downwards, whereas for a bullish signal like just now, you want to wait for the CCI to break upwards. Okay, and with that, I hope that this gives you a clear idea on how to use CCI. Learn these strategies one by one, okay? Don't rush everything and combine together because it's going to make you confused. Alright, so I'll talk to you in the next lesson. Bye.